Hello everyone, today we're going to be discussing the book which Warren Buffett has described as by far the best book on investing ever written. The book is called The Intelligent Investor and it was originally published in 1949 by a man named Benjamin Graham. Graham was a British-born American economist, professor and investor, and he is known as being the father of value investing, which is the investment strategy that Buffett has used to amass his billions of dollars in net worth over the course of his career. To Buffett, Graham was a teacher, a mentor, and a friend, and much of Buffett's success as an investor can be attributed to the teachings of Graham. I myself have read this book multiple times, and as you can see, it is littered with sticky tabs. Reason being, I regularly revisit the principles in this book, primarily to remind myself of what's most important when trying to be an intelligent investor. The book provides lots of little golden nuggets of information about investing, and when combined, all of these nuggets form a profound perspective on what investing is all about. Everything seems to just make sense when you read this book, and what's most incredible is that even though this book was originally published in 1949, Graham's teachings are equally applicable to investing today. What I want to do is to discuss 7 of the lessons which I've tabbed on my copy of the book throughout my many readings, and to share my thoughts with you on why I think they're important. And hopefully by doing so, you'll see why Buffett himself has treated this book as his investing Bible. One last thing, because this is the revised version of the book which was re-released in 2006, there is additional commentary from both Warren Buffett and Jason Zweig. Some of the teachings which I've tabbed actually come from their interpretations of what Graham is saying, rather than from Graham himself, so just be aware of that. The first lesson largely has to do with the belief that we as investors can somehow reliably invest in a company today with the belief that that company will become an industry leader in the future. The best recent example I can give of this is Cathie Wood and her investment firm ARK Invest. Throughout 2020, Wood was praised as being this investing messiah because she offered funds which invested exclusively in companies engaged in disruptive innovation. In other words, she only invests in companies which are either changing the way existing industries operate or companies which are creating entirely new industries. Naturally, investors have a preconception that these companies will be extremely valuable in the future because they'll either replace existing competition or they'll have competitive advantage by being the first to market. Graham challenges this notion through 2 lessons. Number 1, obvious prospects for physical growth in a business do not translate into obvious profits for investors. It's obvious that electric vehicles are the future of the motor industry, but that doesn't mean that every company engaged in electric vehicle production is going to generate massive stock returns for investors. Physical growth alone will not result in large stock returns, especially if you paid too high a price for the stock in the first place. And number 2, the experts do not have dependable ways of selecting and concentrating on the most promising companies in the most promising industries. Cathie Wood and ARK Invest can market their funds as investments in future industry leaders, but the reality is that not only is it impossible for ARK to reliably pick the most promising companies in the most promising industries, but even if they do pick some winners, they have no way of knowing how much money to allocate to each investment in order to maximize investor returns. In other words, imagine you have a list of 30 companies which you believe will be industry leaders of the future. You take 100 grand and spread it across the 30 companies, with the most money going towards your most promising companies and the least money going towards your least promising companies. Maybe you get lucky and 5 of those 30 companies end up being very successful, but how likely is it that those 5 companies were the 5 companies you allocated the most cash towards? Not very. And how likely is it that the underperformance of the other 25 companies will negate the success of the 5? Quite likely. And that's before we consider whether or not you bought these stocks at a reasonable price in the first place to allow for large stock returns. So keep that in mind the next time you want to invest in a company just because it's hyped up to be the next big thing. The next lesson is one of my personal favorites, and it's about you, yes you, the investor. You see, both Graham and Buffett believe that how successful you are in investing largely comes down to your behavior as an investor. Buffett talks about this by saying to invest successfully, what's needed is a sound intellectual framework for making decisions and the ability to keep emotions from corroding that framework. In other words, you need to have a strategy and you can't let emotion get in the way of executing that strategy. I see this all the time. People ask me, should I hold off investing until a crash? Should I wait until the recession is over. But in reality, 99% of the population will be best served investing consistently into low-cost index funds each and every month, irrespective of what's going on around them, almost as if they were robots. The problem is that many people have an emotional attachment to the money they're investing, and that creates anxiety, which subsequently leads to bad investment decisions. Graham says that the investor's chief problem and even his worst enemy is likely to be himself. The fault is not in our stars nor our stocks, but in ourselves. Think of the amount of people who lost money in meme stocks, cryptocurrencies, NFTs, and SPACs during 2020 and 2021. Maybe you were one of them. Those losses came from people making bad investment decisions which were driven purely by emotion, fear of missing out. As Jason Zweig notes, once you lose 95% of your money, you have to gain 1,900% just to get back to where you started. And that's why Warren Buffett's #1 rule for investing is to never lose money. How do you avoid losing money? By having a strategy and not letting yourself get swept up by emotion. Then Jason Zweig comes out with one of the most important summations in the entire book. The intelligent investor realizes that stocks become more risky, not less, as their prices rise, and less risky, not more, as their prices fall. How many times during 2020 and 2021 did we see people rushing to buy stocks because their prices were increasing exponentially? How many of those same people rushed out of stocks once the tide began to turn in late 2021? This is one of the greatest hypocrisies and misunderstandings about stocks. By definition, stocks become more attractive when their prices are falling, but yet everyone has an inclination to sell when they see red. Conversely, stocks become less attractive when their prices are rising, but yet everyone will throw their hat in the ring when they see green, for fear of missing out. You see, the price of every stock on the stock market is a function of what the market expects the company to earn in the future. The higher the stock price goes, the higher expectations for future earnings become. Clearly, higher expectations lead to greater risk of the company failing to meet those expectations. And if that happens, investors lose money. So when people throw money at a stock just because its price is increasing, what they don't realize is that they're buying into a much less realistic expectation for future company earnings. But if stock prices are falling, then the company becomes a less riskier investment proposition, and that's when it could make sense to buy. Not to mention that companies which are expensively priced relative to current earnings are much more susceptible to stock losses when interest rates are rising, and also when there's fears of a recession. That's why you often hear that long-term investors should welcome a bear market and a decline in stock prices, because it puts great companies on sale at a discount. In the words of Jason Zweig, the intelligent investor is a realist who sells to optimists and buys from pessimists. Graham dedicates an entire chapter of the book to the topic of investing versus speculating. It's one of my favorite chapters because it always astonishes me just how many people think they're investing when they're actually speculating. According to Graham, investing is where you have an investment that, upon thorough analysis, promises safety of principal and an adequate return. Speculating is any investment made which does not promise those two things. In other words, in order to be considered an investor, you need to be confident that what you're putting your money into will A, protect the value of your initial investment, and B, provide an adequate return over time. And that makes sense because if our money was just sitting in the bank, it would be secure, but it wouldn't provide an adequate return. So the purpose of investing is to get as close as possible to that security while also generating an adequate return for our money. But what's an adequate return? Well, that could be defined at a minimum as a return that keeps up with the annual rate of inflation. Investing in an S&P 500 index fund will be classified as an investment operation because we know historically the S&P 500 has provided protection of principal and returns which outpace the long-term average inflation rate, whereas day trading in the stock market will be classified as speculation, given that most day traders lose money. Now, that's not to say that speculation should be avoided entirely. It's acceptable to dedicate a very small portion of your portfolio to speculative investments, like cryptocurrencies or early-stage companies, provided you can afford to lose what you put in. But don't be one of those people who dedicates their entire portfolio to speculative investments. It completely defeats the purpose of investing. The next next lesson comes again from Jason Zweig, where he says the value of any investment is and always must be a function of the price you pay for it. What is the value of an investment? Well, you could see it as the potential for gains over the life of the investment from the time you buy it to the time you sell it. What Jason is saying here is that how valuable a given investment ends up being for you is totally dependent on how much you pay for that investment in the first place. Pay too much and its value decreases. Buy it at a discount and its value increases. This is pretty much the crux to value investing, the practice of buying stocks that are being undervalued by the market. But the biggest takeaway here is that many, if not most investors, fail to ask themselves the question, how much am I willing to pay for this stock, before they actually buy it? Remember what we talked about earlier. The higher stock prices go, the more unrealistic expectations become for future earnings. Therefore, it's only logical that you should have a price limit after which the stock no longer becomes attractive. Now, if that seems like too much work, that's because for most people it is, which is why most people shouldn't invest in individual stocks. There's a reason why I keep mentioning low-cost index funds. But if you're adamant on investing in individual stocks, you need to be asking yourself, how much am I willing to pay? And it's on you to figure out that number. Then comes the argument of time in the market versus timing the market, and with it, one of my favorite quotes in the book. In the financial markets, hindsight is forever 20/20, but foresight is legally blind. How many times have you looked back on the Bitcoin price chart and wish you had gotten in years ago? How many times have you done the same for stocks in the stock market? It is very easy to look back and see when you should have bought and sold your investments. Many investors mistakenly think that this hindsight empowers them with the ability to predict the future, and many will try and time the perfect entry and exit based on the past. But in reality, perfectly timing the market is impossible and typically leads to missed opportunities. Bank of America found that between 1930 and 2020, an investment in the S&P 500 would have returned over 17,700% to investors. But if you missed the 10 best days in each decade between 1930 and 2020 because you were trying to time the market, your return after 90 years would only be 28%. Likewise, if you missed the 10 worst days in each decade, your return would be over 3.7 million%. And if you miss both the 10 best and worst days in each decade, your return would be over 27,000%. The point is that your returns can be severely impacted for better or worse by missing just a couple of days in the market. So instead of constantly stressing about whether or not to buy or sell, just buy consistently each and every month regardless of what's going on, and hold those investments for decades. That way your returns will be averaged out over time. Nobody knows where the market is going to go today, tomorrow, next month, or next year, and so your investment strategy needs to reflect that. Best way to do that, long-term investing. One of the key takeaways from Graham's book as a whole is that the future is uncertain. Jason Zweig describes this as a cruel irony, given that we invest in the present, but we invest for the future, and the future is uncertain. So how do we approach this concept of the future as investors? Graham notes that this can be done in two different ways: the way of prediction and the way of protection. Those who follow the way of prediction will try to invest in those companies who are expected to be the industry leaders of the future, which we've already talked about. Those who follow the way of protection are obsessed with asking the question, how much am I willing to pay for this investment? They are obsessed with protecting the value of their initial investment and with generating adequate, not exceptional returns. Why? Because they understand that anything can happen in the future, and so trying to predict it is a fool's errand. Instead, their energy is best spent figuring out what investments they can make today in order to place themselves in the most protected scenario in the future. So that's 7 lessons from Warren Buffett's investing Bible, The Intelligent Investor by Benjamin Graham. Those of you who have read the book might be wondering why I didn't mention the lessons around the margin of safety or the characteristics to look out for in high quality company stocks. Honestly, this book, along with the teachings of the likes of John Bogle, have shown me that for the most part, I have no interest in investing in individual stocks. Have I done it in the past? Yes. Will I do it in the future? Probably. But for now, I'm perfectly happy investing for the long term via low cost index funds. It's less time consuming and less stressful. And the last thing I want to do is spend my free time researching companies, when in reality, my predictions will be no better than the market as a whole. Does that mean I won't consider individual stock investments at all? Of course not. In fact, I really enjoy researching high quality dividend paying stocks. But what I'm saying is that the vast majority of my investing activity will, at least for the time being, be contained to index index fund investing. But I want to hear from you. What are your thoughts on the 7 lessons which we've discussed? Have you read The Intelligent Investor? And if so, what were your biggest takeaways from reading it? Let me know in the comments. So I really do hope you enjoyed the video here today. As always, if you did enjoy the video, please do let me know in the comment section below. Leave a like in the video, subscribe to the channel, and I'll see you in the next one. Cheers.